Welcome. Today we'll be looking at 5 stocks which are trading at 52-week lows in September 2024. Starting off with AirBNB, ticker symbol ABNB. I'm assuming most of you know that this is in the holiday rental industry, and as we can see, due to their latest guidance in their recent earnings, their stock is actually trading down. In the past year, they have returned -7%, and they're currently around 52-week lows. As we can see, however, their price to earnings ratio has been more or less consistent for the past year. Right now, we could say that it's trading right about average, as the PE has not had any big moves recently. It's a fast-growing company, and it has not instated a dividend, as it is focusing on reinvesting everything that it makes back into the business. Now, when looking at the revenue and income evolution, we can see that the revenue was the highest in Q3 2023. Their third quarters tend to be the strongest ones because it aligns with the summer period, which is when the majority of people around the world actually take their holidays and travel abroad, which is the time of greatest demand for Airbnb. Now, we can actually see that from Q4 2023 all the way up to now, their revenues have actually been increasing. And one extremely positive thing about Airbnb is that since they are a platform and they have very low capex, very low operating expenses, it's very easy to keep their margins extremely consistent or even rising with rising revenue. One thing I love from Airbnb is their incredible ability to generate free cash flows. Now, as we all know, in order to get your free cash flow, you have to do your cash from operating activities minus the company's capex. However, in the case of Airbnb, these two are extremely similar because capex is almost non-existent. And as TradingView does not have the free cash flow from the latest quarter, we are going to use cash from operating activities instead. And as we can see, for the past year, they have been extremely consistent every quarter to obtain positive and very high free cash flows, except for Q4 2023, where they of course had negative net income. And finally, they're in a solid leverage position. One thing that I do not like is that their total assets and total liabilities have increased a lot from Q4 2023 all the way up to now. This inherently decreases all their efficiency ratios, such as return on assets, return on capital employed. However, as long as their total assets are above their total liabilities, I believe that this is a very solid company. Now, moving on to Etsy, which is one of the biggest internet retailers out there. It focuses mainly on handmade products. Their stock is down 23% for the past year, and of course, it's also trading near 52-week lows. When we look at their valuation ratios in Q4 2023, they reached a PE ratio of higher than 35 times, and now it's trading just under 30 PE ratio, which is pretty solid, and it means that the company may be at a discount in relation to their past valuation. Again, Etsy does not pay a dividend. They're focusing mainly on growing their business, and instead of returning cash through dividends, they are doing so through share buyback programs. Now here it looks like Etsy's total revenue is not actually moving too much. As we can see, for the past 4 quarters, it has been extremely stable if we do not account for that rise in Q4 2023. And of course, their margins have also been extremely stable. Now, their cash flow evolution is perfect. As we can see, before Q1 2024, they were having growing cash flows. And I believe that in 2025 or late 2024, they will get that free cash flow generation going again. Now, one thing that I do not like is that they have higher total liabilities than total assets. We have to conduct some deeper dive in to see what actually causes this. However, what this means is that they owe more than what they have, which most of the time is a red flag for companies. Stock number 3 is Monster Beverage, ticker symbol MNST. It's in the energy beverage industry, which is being beaten down recently because of regulations and because there was a small bubble around this industry the past year. Now, this stock is down over 18% for the past year, with its PE ratio currently sitting at around 32 times. Now, MNST does not pay dividend, but it is a monster at share buybacks, and it has been doing so for a very long time. Now, one amazing thing about this company is that although they're a mature business and their total revenues are not growing as much anymore, their margins are extremely solid, with net income margins sitting above 20%, which is something amazing, especially for a company in the beverage industry. And now what I love most about this company is their free cash flow evolution and their ability to generate extremely consistent, sustainable, and even growing free cash flow quarter after quarter, which allows them to conduct those huge share buyback programs that they do. And now finally, when considering their leverage evolution, their total assets are way above their total liabilities, which is something extremely positive. And another positive thing is that in their latest quarter, they reduced their total assets by a lot, meaning that they have improved their efficiency ratios, and we will have to see where they go from here. Stock number 4 is Paycom Software, ticker symbol PAYC, and this is in the human capital management industry. Basically provides a software for all the human capital management needs of the different companies, and this stock is down 43% in the past year. This company has had some uncertainty and some troubles with their management, but nonetheless, it is now trading just over 17 times earnings. Now, this company started paying a dividend in 2023 and is holding a dividend yield of 0.92%, which, although may seem small, it's a step towards the right direction, and this is something that will allow them to return a lot of value to shareholders. Now, when we look at the revenue and income evolution, this company is known for having a pretty high growth rate regarding its revenue, gross profit, and net income. Now, if we look at Q1 2024, it looks like they had some one-off items as their net income was so much higher than all the other quarters. However, if we look at Q2 2024, this got resolved. What I also love about this company is their free cash flow generation. It is predictable, it is growing, and it is sustainable, which allows them to not only pay that dividend that they just instated, but also buy back shares. And finally, this company is actually leveraged, but they're using it in a financially responsible way, as their total assets are above their total liabilities, and they're using this in order to grow at a faster rate. Now, last but not least, Wynn Resorts, ticker symbol WYNN, is in the casino, gaming, and entertainment industry, and it is at 52-week lows, down 19% in the past year. Now, as we can see, their price to earnings ratio looks a little bit weird, and this is because in Q3 2023, they have very small earnings, which caused the price to earnings ratio to be extremely high. But as we can see, currently they're trading at a price to earnings ratio of close to 12 times. Of course, this company does not have huge earnings growth, but they're currently paying a 1.29% dividend yield, which is something extremely decent, especially for a company trading at such a low valuation. Now, this company's dividend has grown at a negative 9.14% 3-year CAGR, but this is because they had to suspend their dividend in 2020. If we look previous to this, in 2019, their dividend yield was a lot higher. Now, the revenue for this company will not grow exponentially because it's more in the real estate business and it's something extremely stable. Think of this more as a rate. It's more of an income play rather than a growth play. This is why their margins are so adjusted. However, they should do the job in order to bring sustainable net income, which will allow them to produce these sustainable and predictable cash flows quarter after quarter, which will allow them to, first of all, bring back that juicy dividend, second of all, buy back some shares, and even third of all, just invest and buy a lot more property. Now, one thing that I don't like about this is that their total liabilities are actually higher than their total assets, which may bring some sort of a red flag, as this usually indicates that their equity is negative as they owe more than they have. Now, before we move on, please remember that this is not financial advice, so please do your own due diligence. However, thank you for watching. As always, this has been the Cashflow Compounder. Join the Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.